What if BlackRock, Goldman Sachs, and 28 other top investment firms all pointed to the same big shifts for 2024? Sounds unlikely, right? But believe it or not, they do. And these insights could transform your portfolio this coming year. Stick with me and let's explore what the world's most powerful financial players agree on.
Oh, yeah.
I have finished reviewing over 30 comprehensive outlook reports from Morgan Stanley to Schroders to find the 5 most urgent trends shaping global markets in 2025. With interest rates still high, inflation proving stubborn, and cross-border opportunities making headlines, understanding these themes isn't optional. It's essential. As Goldman Sachs put it, 2025 stands at the crossroad of post-pandemic recovery and renewed economic headwinds. The big question is, will you position yourself wisely or get caught off guard? Trend number 1, higher rates and sticky inflation. Morgan Stanley warns that persistent inflationary pressures could keep central banks' policy tighter for longer than markets expect. Meanwhile, Barclays echo a similar stance, cautioning that even a slight uptick in inflation could trigger more aggressive rate moves than we saw in 2024. The consensus here? Short-term bonds and TIPS, which stands for Treasury Inflation Protected Securities, remain popular picks to weather any lingering inflation. Some also mention holding floating rate notes, which can benefit when interest rates rise further. If you are worried about inflation eating away at your cash, these assets could offer a protective shield. But it's not all defensive. Bank of America highlights that sectors like technology and industrial automations can still thrive under certain inflationary conditions, especially if they boast pricing power. So, don't assume high rates are the end of growth stories. They might just be more selective. Trend number 2, soft landing versus slowdown. High rates often spark a question. Does that automatically means a recession? Not necessary. Fidelity is talking about a soft landing scenario where GDP growth decelerate but avoid a total collapse. They see resilient consumer spendings and job markets, especially in developed economies like the US and parts of Europe. But not everyone is so optimistic. West cautions that corporate earnings could erode more quickly if consumer sentiment drops or wage pressures rise faster than expected. These suggest we may get a mild pullback in equity markets if economic data disappoints. If you're on the fence, consider defensive sectors like healthcare, utilities, or consumer staples. Deutsche Bank points out that these segments historically holds up best when economic growth takes a hit. Keep an eye on the quarterly earning calls because any signs of weakening consumer demands could tip the scales. Trend number 3, global diversification. So, what if growth in the US or Europe underwhelms? According to UBS and BNP Paribas, emerging markets in Asia could be the new frontier. They reference a growing middle class and accelerating e-commerce as key drivers for long-term expansion. Pictet AM even states Asia's tech and digital sectors are poised to outpace global averages, potentially offering higher returns for the risk tolerant. Of course, you must watch out for currency volatility and be mindful of geopolitical tensions. HSBC says investors can't ignore China's role despite short-term policy uncertainties. Whether it's India's infrastructure push or Indonesia's shift into digital finance, the big players see significant upsides but stress caution around regulatory risks. The bottom line, diversify beyond your home market. Spreading your portfolio across multiple regions can help buffer against localized slowdowns and might even capture pockets of growth that others have missed. Trend number 4, thematic and ESG investing. Amandi, Lazard, and Schroders are especially vocal. Lazard notes that the energy transition will require trillions of capital investments globally, implying a steady pipeline of potential opportunities like clean energy, smart grids, and battery technology. Meanwhile, Schroders singles out water security and health tech as top priorities for both governments and businesses. Demand for innovative healthcare solutions and sustainable water infrastructures will only intensify in the coming years. If you're looking for growth narratives, these must be less sensitive to short-term market swings and more tied to long-term policy and demographic trends. Just remember, ESG isn't purely philanthropic. It's also about risk management. Companies that manage environmental impact well may face lesser regulatory hurdles making them potentially safer bets in an evolving climate-conscious world. Trend number 5. Cash and alternatives. Finally, what about protecting your downside or seizing short-term opportunities? Bank Group and Apollo champion a solid mix of liquid alternatives like private credit, hedge fund strategies, or REITs, which stands for Real Estate Investment Trust. They argue this approach gives you diversification away from traditional equities and bonds. If you still want an opportunistic edge, keep some cash handy. As Wells Fargo's put it, a modest cash reserve lets investors capitalize on flash sales in the market without liquidating core holdings. Plus, it doubles as a hedge if volatility spikes and margin calls arise. The overall message: combine alternatives with a cash cushion. These strategies aim to keep you afloat if market dives while also allowing you to act quickly if a compelling opportunity appears. So, to recap, rates remain elevated, we might see a soft landing or a mild slowdown. Global diversification, especially in Asia, is on the radar. The ESG and thematic plays could be major winners. Plus, cash and alternatives offer both defensive and offensive. Preparation is the antidote to uncertainty. If you're serious about tackling these 2025 trends head on, subscribe now because we will be sharing in the upcoming videos and looking into portfolio strategies you cannot afford to ignore. The right preparations today could define your success tomorrow. So join us as we dive into this topic together.